I think the first topic I wanted to talk about, and we can get to these afterwards, but I think I mentioned this before. I got a very interesting question is, how do you pay for the exercise cost when you actually are exercising employee stock options? I know the different methods, but it was interesting from a point of view explaining it to a client. I just couldn't explain it easily.
I think that when you hear that question, correct me if I'm wrong, but I think your mind starts spinning with possibilities because there's a lot of answers, right?
Let's assume the company is private, right? Because this is the majority of the cases where you get incentive stock options or non-qualified, stuff like that. They're private still.
Paint the picture of the problem for someone who may not understand this quite so well.
Exactly. Yeah. So company private, you received, you're working there for 3 years ago, you received, or you started a little bit more than a year ago, sorry. And you received non-qualified stock options, and you received an incentive stock option grant also. So now they're vesting, and you want to start exercising this stuff. How do you exercise this? It's an issue, right? You have a little bit of savings. The fair market value of the company for the 409 valuation is pretty low, so there's an opportunity there to exercise it and not pay a lot of taxes. So and the strike price is pretty low; it's all manageable. So now you have to exercise them, and to exercise them, you need capital, and you're buying. You have an option to buy shares, and to actually have to go to the company, give them money, and with giving them that money, and you buy the shares, and the shares magically pop up in one of these platforms, or maybe not. They just send you a letter saying you own these shares. So easiest way, usually like these companies they've contracted with like Carta or some other platform, and you just send money to a location. You do a wire transfer, or I don't know if you can do an ACH, but and then you essentially tell them you want to exercise either through a click on the button on the platform, or you instruct them in the letter or whatever to say that you want to buy X amount of stock with this capital. And that's essentially the easiest way to exercise it.
Give us an example, how much this might cost, in the context of a comp plan. What have you seen, like a range? What's a small exercise and what's a big exercise in terms of dollars to get this done?
It really depends when you join, right? Because it all depends what the strike price is for the stock. Sometimes I see like companies at, employee number 15 or 30, they're in the cents, right? So like 15 cents a share. Somebody who's joined a company that's gone through like several rounds of funding, and their shares have become more expensive, and suddenly you have like, I don't know, 5,000 shares and 1,000 just vested, and it's like $22 each, right? That's a lot. Like imagine like just having to transfer over $22,000, right? So to buy stock. Versus the other person who maybe has like 15 cents. You're purchasing 1,000 shares at 15 cents a share. Now that's what you're talking there. When you actually arrive at a company and you know that they will succeed, or you have this instinctive feeling, I should look into the 83B. It has to be done pretty early on, along with a grant, right? So I think the rule says 30 days for the grant.
30 days.
You still early exercise it afterwards, right? You can't issue the 83B.
I think that 83B, in order for 83B to be relevant for ISOs, that you have to have the option to exercise early.
Yeah, and not everybody allows that.
Right.
That's another issue.
Right. Okay, so again, we're facing the main issue here is that someone works for a private company. They have options as part of their comp plan, and in order to get access to the shares that are granted through those options, you have to pay for them. You have to exercise them. There's going to be some cases where this is very affordable and out of normal cash flow. Some people wouldn't even see a blip in the 15 cent per share strike price that you talked about. In other cases, I will say that I have seen a case in the past month where someone was looking at I think $1 million exercise cost before taxes.
That's beautiful.
Yeah. $1 million exercise cost just to get his options, just to exercise them, right? To buy the shares that were granted to him in his comp plan. So big range. The question that we're facing here is, how do you do that? How do you get that cash?
Yeah.
Again,
And
the
so this
easiest one that you've said so far is just use cash.
essentially what you're doing is that you're exercise some things and you're actually selling it at that moment to fund the exercise of the remaining options. But you need a market for that. And so, unfortunately, when companies are private, you're at this disadvantage point if you don't have um, cash at hand. I've had one client who actually took out a loan from their 401k to exercise before a company went public, and that's an alternative. But you have to find the money somehow if it isn't a publicly traded company, and that's the tough part.
You don't have to. If you want to exercise, you have to. If you want to exercise, you need to get your hands on cash ASAP. So it sounds like maybe the second group of things is borrow the cash.
That's exactly. There are firms out there that will loan out the money using as collateral existing assets or some other assets.
Broadly, we have pay for it with cash if you're lucky enough to have the cash there. The second chunk of things is borrow. And within that, there are a bunch of options. So if you have access to lines of credit that are cheap, some people have personal credit lines that are not, credit card level interest rates.
Some personal family.
Some people have family that could be a great option. Some people have equity in their home or an untapped home equity line of credit. That's another place you can borrow in a lot of different ways. And I think what you just talked about, I've seen a bunch of these firms who are in the business of helping employees with this exact problem. So I think if you Google what we're talking about today, you'll probably get served ads from companies who make their money, make a little bit of a vig, a spread on lending money to employees of startups whose stock is not traded, right? It's still private. In fact, I was searching yesterday to see how good the content on YouTube is about alternative minimum tax credit, which is not good, by the way. We should make an AMT credit video specific to that because the content was terrible. But the few ones that had tried that were specific to were firms that are functionally pitching their services, right? That say, hey, we'll lend you money. And I agree with your assessment that generally, like, if there's a big tax advantage to be harvested, look at the cost and look at the benefit and analyze those. It's not necessarily a bad deal. I think there's definitely some complexity and kind of counterparty risk of just like entering into a complex transaction to get that done. I prefer simplicity when possible in this area. In a cashless exercise, you're pushing two transactions into one, and you're using the proceeds at the end to functionally fund the beginning. So it's kind of this little circular thing. But ultimately what you're doing is at one time, you're doing both the exercise and the sale on your options, and you're using the proceeds of the sale to fund the beginning, to fund the exercise. And if you're lucky enough to have this option, a company is going to make this hopefully fairly operationally straightforward, right? Where it's, the two transactions happen together at the same time. And again, the purpose is that you're not coming out of pocket to go and get those shares exercised.
Yeah. So essentially, I think the formula was the cashless shares, required to do this transaction is essentially the exercise cost. So let's say the exercise cost is, $50,000. And at the moment when you're exercising at the fair market value of that exercise of that share is $25. So the required shares that you need to do this entire exercise is 2,000 shares. And the way you get it is dividing the $50,000 over the 25 shares. So base $25 per share. And so essentially you need 2,000 shares to fund the entire exercise. When you're confronted with people who have a lot of shares, the best strategy is to get the ball rolling and starting the exercises early to pay the least amount of taxes.
Agreed. Yeah. In a bull market, I totally agree with you.
Yes. Unfortunately, we rely on bull markets here.
That's right. Powered by bulls.
The other way, I think this is a stock swap. Imagine you already have in your account, it's essentially a mixture of both cash and cashless. It's just the difference is that instead of holding cash, you have stock from a previous exercise. You haven't sold it. So essentially what you're doing implicitly is you're going from you're essentially in this process. You're selling the stock.
So we've got use cash on hand. We got borrow some cash and go and scramble it, get it in hand, and all the various ways there are to do that. We've got cashless exercise, which again, I don't think, and correct me if I'm wrong, I've never heard of a private company being able to cashless exercise.
No, not even tender offers. Usually, a tender offers, you need to have the shares already there. That's from a certain date. You can't just exercise them right before the tender offer expires. That's
right.
Not how it works.
Right. So the key feature of a private company is illiquidity, right? You can't get your money same day. So cashless exercise, therefore, it doesn't make sense to do because the transactions are too slow.
You have to account always for it. It will take money to just transfer in money into your account. So if it takes 7 days or 5 days and suddenly the fair market value went up of the company, and then you're just going to be saddled later on with a bigger tax bill. So it's always good what is the right strategy here? It's, fund your account earlier than you think you should.
Yeah. And maybe when you get your grant, you should, at the very least, calculate out your exercise costs over the next few years and think about that as part of your ongoing funding. Because what I hate is the scenario where someone thinks that they can't afford to exercise because they just booked a Hawaiian vacation. And they're like, oh, I'm lower on cash because, I bought a car or, paid off my mom's mortgage and therefore I can't afford to exercise. It can fit in the context of a broader plan, right? And you don't need to use your perception of relative financial strength. You need to use all the context around whether or not this is a good idea to exercise, and if it is, let's use some of these tools in the toolbox to get it done.
Yeah. So it's essentially in summary, there are three big ways to exercise a stock. One is you transfer in cash, you exercise. The second one is in a publicly traded company, you're more likely you can do this, which is the cashless exercise. And then the final one is probably a stock swap, but essentially it's a mixture of both.
So I have a friend who has an accounting background. He's a CPA. He's worked for a couple accounting firms, has worked his way up. He's still early career, so he's 30. He is well compensated because he's done good work and been promoted and changed companies. And he works really, really hard, as you might imagine. These consulting companies run on the back of young CPAs doing hard work for many, many hours, and is thinking about what the next step might be. And from my conversations with him, he's interested in the RIA world, which I think is a really good fit personally. But I'm wondering your take on a couple things. One is, is it realistic to say that someone who's a CPA consultant, doing consultant work for corporations, right? It's on a different part of the finance world that his professional life is now. Can someone like that make a switch into the RIA world, become a financial advisor, and two, how much of a pay cut is he going to need to take in order to get that done? And it's okay if you don't know specifically, but that's the question.
I think I'll answer the first one. I think it's for someone who's coming from an accounting background, specifically in a tax background, and specifically for personal. So the thing is, like in the accounting world, you're practically separated into two as the moment you start in doing a career in accounting. One is, or more, but mainly two, tax and essentially accounting. Right, so accounting eventually leads you to become controller of the company, and in many cases CFO. Right, so if you want to become a CFO, you start in accounting. You're essentially preparing the financial statements of a company. On the tax side, you could, if you work in a corporation, the career path is eventually to head of tax, which works under the CFO usually. If you do the personal side, I think the end game here is you either go specialization, like complex stuff, like international taxes, like some sort of like weird tax within international taxes, or you do kind of broad stuff. You handle one individual person, but you do everything for them. And I think that kind of person is the one who's better fit for being a financial planner. And the reason why is because I think financial planning, at least a third of it is easily tax stuff. I think the other third is soft skills, like soft behavioral things. And the other part is everything else. Pay cut. Depends where you are. And if you're working corporate, I don't know exactly where it works, but usually there is a pay cut until you build up your client base in financial planning. I think at the end of the day, financial planning, investment management, being that person could be more lucrative than, I'd say that the range is bigger, but probably the median is lower.
In which one?
In financial planning.
Got a wider range of outcome, lower median, but higher upside. I've had this idea that, and someone who does it is, oh my gosh, I can't remember his name. Radical Personal Finance. I think his name is Joshua Sheets.
I listen to him. He's a podcast.
He's a podcaster, yeah. And he does a thing that I really like where he takes listener questions and he answers them on the air, and they're fairly anonymized, right? But I think that's actually a pretty good, I really like that idea. I know that I won't ever get to a place where client meetings are being recorded or broadcast because they're extremely personal, right? This involves social security numbers and people's hopes and dreams and their net worths and all these things. But I do like the idea that, I don't know, in the future we'll be able to scrutinize that more acutely. And Josh Sheets on his podcast, to his credit, does give. It's funny. I think technically, according to regulators, he would say, "Oh, I'm not giving advice," but I'll leave that up to interpretation as to whether or not that's happening. There's plenty of those call-in shows, right, where people call in and say, "Hey, I have X, Y, and Z going on financially. What do I do?" And they're not regulated for giving advice. So I don't know where that falls.
In terms of the other topics, what I wanted to talk about today is inflation. I got a letter the other day from the BLS asking about my rental.
Oh, really?
Yeah, first time I've ever seen it. I emailed the person and the email bounced, so I gave up. Apparently, the person had put in the wrong email address on the letter. Apparently, they said that they're surveying 16,000 homes in my area to see what the price inflation has been on rental units. I'm going to venture and say that rental units have not gone up much in price, but I will say the homes around my area have gone up probably 15-20% since the pandemic started. It's insane. We are actively looking to buy a house, and houses are going for above asking, maybe 5 to 15%.
The BLS is at least statistically interested in your rental data. What are your thoughts on inflation as they stand today? What have you seen? What have you heard? What are you feeling about it?
I think I'm convinced that this inflation scare is not going to be realized. I think what's going on right now is that we have a dislocation in the market in terms of where the demand sits and where the supply sits. But eventually that will be cleared up. The market will react and it will clear up. I think the problem is that there are certain areas where there will be continued, I would say, unmet demand, and that will probably lead to inflation. But right now, there's lumber issues, right? Lumber has gone up in price tremendously, and it affects construction costs. It's not that there isn't enough trees there. It's just that there's one point in the supply chain where there's a chokehold. Look at chips. Chips have gone up in price. There is supply chain issues across the world because of due to chips, cars specifically, but there are other things that are being put on hold for production. There's now a lack of containers going out from China. So in the world, there's a lot of containers, right? But they're not the right amount of containers in a specific location where the demand is. So usually containers in China are worth way more than containers somewhere else, because nobody wants those containers, but they want containers in China because China is actually always producing. In business, the right path forward is, filling up stuff from China to, let's say, the US, but then also filling up stuff in the US that goes to China, and then you have utilization of the container. But in many cases, those containers just go back to China empty. And so that's an issue you have, but it's always existed. So I think we're going to see like maybe a burst of inflation, which is not bad, because if we have growth, like real GDP growth, pretty high, then obviously what that means is probably that a part of that will be inflation if you look at the nominal way. Meaning that, let's say if you grow 10%, there's a strong likelihood that that growth is going to also lead for some inflation. And so the real growth will be maybe 6%.
So you think it's the current bond market woes, inflation talk is likely to be a head fake, specifically that it has to do with supply chains?
I think that, but I still think the rates should go up. I think so the real rates, meaning that if you take the difference between the rate minus the inflation, it has to stretch out a little bit further. It can't be that, in some cases, parts of the yield curve is trading at, or essentially you're getting less money because inflation is eating it up. And that's not right. If inflation is going to be 2% going forward, stabilized, which is fine, not like the 5 or 10% people have like been like crazy estimating, then rates should be above 2%, right? That's normal. It's okay. The savers should get like, they should be rewarded above inflation. Right now, you might not have that, so that's an issue, and it's just bad for the economy in general. The companies that will benefit the most from this, I think, will be financials, right? Because if you keep the short end of the curve so low, so that if the banks pay the depositors 0%, but then they're able to issue loans at 4%, there's a huge chunk of margin that they're making, and they use that to pay expenses and everything else, and they can pay dividends and bigger, fatter returns for investors.
Let me ask a question on this topic. If an investor reads a headline and decides, or reads a bunch of headlines and reads research and decides that they're worried about inflation, what should they do? Should the average investor be changing their portfolio based on expectations of inflation or realities of inflation?
So my concern right now for my investors is to be on the long end of the interest rate curves. Think about all those funds that basically hold long-term treasuries or long-term corporate bonds. If the bonds they're holding there are worth 2%, and then suddenly there's a little bit of inflation, or the rates return to 4%, your bonds are worth less than par, so less than 100. So what that means is that the bond prices are probably likely to go down. Your fund, the NAV of your fund, the value of your fund will probably go down. And so as a result, it's probably better to be on the short end of the curve, which, let's say you have a 6-month treasury bill, which is yielding at 0.5, but in 6 months you get the money back and you can reinvest it in higher yields as yields go up. The problem is that the short end is not going up in yields, and the long end is going up. So overall, bonds is not very an attractive moment right now to be in. Just to wait until the rates go up and stabilize, and then at that point, I think it's going to be healthy to go in and buy these bond funds.
I see. So the place to look, and I would agree, if you're looking at your whole portfolio and you say, I'm scared of inflation, the place to be scared is in bonds, is in your fixed income, right?
Yeah.
So the more conservative,
long-term, yeah,
specifically long-term bonds, the more conservative that your portfolio is wired, counterintuitively, it's likely that the more exposed you are to inflation risk.
Yeah. And the other part where you should be worried is if you have a lot of growth stocks. The growth stocks are valued, most stocks are valued implicitly somehow on their future cash flows. So it's basically like, okay, I'm buying a future stream of unknown cash flows, and the market kind of dictates that price. But in order to get to essentially present value, meaning to compare apples to apples, you need to, those long-term future cash flows, you need to bring them to today and basically say like, okay, what are these future cash flows worth in today's dollars, and compare them against another company's medium-term cash flows. I compare them somehow, And the way you compare it is you use what's called a discount rate. So you're discounting those cash flows by a percentage, and that percentage is very much tied to the interest rates. So the higher the interest rates is, the more you will demand from any company, the higher return. And higher returns affect those companies who have positive cash flows, but in the very future. If you have positive cash flows today, that's today's money. Like, you don't have to discount it with any rate. It's because it's today's dollars. But future.
To wrap it up, look out. If you're scared of inflation and scared of interest rates rising, look out in your bonds, specifically the long dated portion of your bonds. Also look at growth stocks, actually for a similar reason, because growth stocks are functionally, you're worried about long-term cash flows further out in the future. So interest rates up means longer term cash flows are less highly valued.
It was good talking to you. And I hope you have a great rest of the week.
Thank you. You as well. Catch you later.
Say hi to the fam.
Will do. Adios.